Eventually, when that busts, you see the debasement in the credit value and the purchasing power of the dollar goes down, not just in individual dollar units, but in the total market cap of all dollars that exist goes down. And all of that purchasing power heads back into money, into gold itself. And that's why during a bust, the purchasing power of gold goes up relative to the purchasing power of all dollars. Even if the value of an ounce of gold goes down in dollars, still the purchasing power of it goes way, way up.
My year-end target in gold is 6,000. I put that target out at the end of last year. I don't have any reason to change it, but it got close at 5,600, not so close at 5,000.
Recent analyses and expert forecasts, particularly following gold's strong performance through 2025, have raised the possibility of gold reaching $10,000 per ounce by the end of the decade. While this is considered a long-term, highly optimistic target often dubbed a bull case or tail risk scenario, several market commentators believe it is achievable under specific economic conditions. Most people think all commodities are an inflation hedge, but history says otherwise. Renowned monetary commentator Rafi Farber and GaryWagner discuss strong views on gold as a hedge against currency debasement. Rafi Farber highlights that during the 1971 to 1980 debasement, only oil and gold truly protected purchasing power, and gold was the undisputed leader. In Farber's view, we are entering a phase where gold isn't just another commodity on the board, it's the monetary escape hatch. Regarding industrial commodities, Farber says they face demand destruction. Gold will continue to rise relative to other commodities as the Federal Reserve prints more money. He describes this as the second phase of the gold bull market, when investors realize the Fed is losing control of long-term interest rates and cannot stabilize markets without massive bond purchases. In 2025, global gold demand rose to 5,002 tons. Key drivers included geopolitical instability and strong investor interest. Supported by record prices, the total value of gold demand surged by 45% to $555 billion, while investment volumes reached 2,175 tons. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from Rafi Farber and GaryWagner's recent interview.
Before I show you the chart, I'll just explain that there are two possible results to a money printing round. One is that it creates a credit boom, where the purchasing power of credit, of all of credit as a market cap of credit that exists, the purchasing power of that stuff in the economy increases, and the purchasing power of money bleeds at the expense of credit. So the price of gold, which is money, goes down at the expense of credit, which is the total market cap of dollars that exist. This we call a credit boom. It makes people feel that they are richer than they are. They can afford more assets and they can afford more stuff because they can finance it at lower interest rates. So what creates a credit boom is low interest rates, where people can consume more, go higher into debt, get more assets, and this triggers industry to create more of this stuff, and it creates an economic boom. Eventually, when that busts, you see the debasement in the credit value and the purchasing power of the dollar goes down, not just in individual dollar units, but in the total market cap of all dollars that exist goes down, and all of that purchasing power heads back into money, into gold itself. And that's why during a bust, the purchasing power of gold goes up relative to the purchasing power of all dollars. Even if the value of an ounce of gold goes down in dollars, still the purchasing power of it goes way, way up. So to put it succinctly, a QE round can either create a credit boom, which will bring the value of gold down and the value of credit up, or it can just create debasement, which increases consumer prices and doesn't do anything for asset prices at all. And there is one way to tell what is happening. Are we going through another credit boom, or are we going through a debasement where it's just the prices of consumer products that go up and make everyone poorer, and there is no credit boom? Because if that's the case, then this is the last round of money printing and there won't be another one. How we can tell is if long-term interest rates are heading down as the Fed cuts the federal funds rate, then that would create a credit boom because most of industry is dependent on the 10-year rate, 20-year rate, 30-year rate, long-term rates generally. So if those rates are going down as the Fed is cutting, then the economy is following the Fed into another credit boom. And that means that there will be some time before the end game hits. But the question is that happening now? And the answer is emphatically no, not this time. Commodities will rise, but gold will go up faster, just as in the 1970s. From mid-1971 to early 1980, the gold price rose by 25 times, whereas the copper price increased by only 2.4 times, lead by 4.3 times, tin by 4.8 times, nickel by 2.2 times, and zinc by 2.4 times. Only oil kept pace, increasing 22 times. These were big increases. Tripling a price over 10 years yields an annual inflation rate of 12%. But the effects of debasement were nevertheless muted by demand destruction, meaning the effects of debasement were muted by demand destruction. That means that there was less demand for these commodities, where debasement would bring the price up in dollar terms, because that's what debasement does. Demand destruction brings the price down otherwise, because it goes in the opposite direction. Less demand, lower the price, which is why those consumable commodities, industrial commodities, didn't go up as fast as gold did in the 1970s. Now, he gives an example of this, a concrete example of what debasement does versus a credit boom. To illustrate, beef is a commodity, and viewed in the abstract, a ranch may appear to be safe haven from the ravages of inflation. They can't print more cattle. Initially, customers like Kindling, that is a restaurant, will suffer some margin compression to keep their customers and perhaps hope for a price relief, not knowing if the higher prices of beef reflect a temporary supply shock or debasement, allowing the rancher to increase his prices to cover the rising costs of his own inputs. But with only 5% gross margins on each meal, remember this is a restaurant, they get about 5% margins on each meal, Kindling can suffer food and alcohol price increases of only 13% after the 40% last year before there is no margin left. The restaurant has to raise prices. That's fine if the Fed's printing has engendered a new bubble, a new credit bubble, and Kindling's customers can pay the higher prices. But if general price increases are the effects of debasement, the price is simply masking the country getting poorer, then Kindling can't survive. The higher prices end up lowering sales volume to an extent that the fixed capital expense allocated across a declining number of meals makes the restaurant lose money on each meal. The restaurant closes. The rancher loses a customer. The rancher suffers the same fate. He must raise prices to cover rising input costs, but finds that increasing prices loses customers. The same dynamic applied to copper and steel and lumber and tin. This is why industrial commodities did not keep up with gold in the 1970s. Preserving gold mining margins, we think similar dynamics are at play again with two major outliers, oil and silver. So basically he's saying, Daniel Oliver is saying that we are in a debasement cycle now, which means that business is going to go down. The prices of industrial commodities are going to rise, but not as fast as gold. The price of gold is going to go higher and higher relative to other commodities. And as the Fed prints more and more money, they are going to debase further and further, and it's going to destroy the entire currency. How does that work? He gets into it right here. This is the endgame described by Murmichan, and he uses the word endgame. The words endgame, they're two words actually, right? End and game. This will be the second phase of the gold bull market, a move that has not yet begun, the move to reflect the market realization that the Fed is powerless to save private equity or control interest rates without buying the entire bond market, meaning the Fed can't control interest rates anymore. As we see, the 10-year yield is going up as they are cutting rates right now. They are starting to lose control already. The third phase will be when higher rates create a government bond death spiral. The higher the interest rates rise, the larger the interest payments go, the worse the deficits, the greater the supply of treasuries, and the higher rates will rise. This is the rapidly intensifying government crisis. Either the government defaults or it orders the central bank to buy any and all treasuries, destroying the currency. This has always been the endgame. And then he quotes Mises, who you can see in my background. There is no means, this is from the book Human Action, I believe. There is no means of avoiding the final collapse of a boom brought about by credit expansion. The alternative is only whether the crisis should come sooner as the result of a voluntary abandonment of further credit expansion or later as a final and total catastrophe of the currency system involved. So, how do we know, the royal we, or you could say Daniel Oliver and I, how do we know that this is going to be the final round of money printing when they start QE again because they've lost control over long-term interest rates already. And as they cut more and more, they will be forced to buy more and more bonds, and that money will stay within the US. Countries will be forced to use gold rather than the dollar as a settlement medium, and the dollar will die on the next printing round. The only question is, when does that start?
Gold has demonstrated exceptional performance, with prices surging by over 60 to 70% in the past year, driven by intense central bank buying, geopolitical uncertainty, and high investor demand. Gold prices may remain highly volatile this week amid the release of FOMC minutes, U.S. jobless claims data, other macroeconomic reports, and commentary from Federal Reserve officials. GaryWagner underscores that the long-term roadmap for gold is still firmly intact. Even with the recent volatility, the market is respecting the 38% support level, proving that the bullish structure is solid. Wagner views the area between $4,600 and $5,400 as the new neutral zone. He stresses that gold remains in a bull market as long as it stays above the 50-day moving average. The RSI sits near the middle range, showing the metal is neither overbought nor oversold. Gold is consolidating, not collapsing, and a confirmed move back above the 20-day moving average could signal the next breakout attempt. Let's jump into the interview.
As you can see, from this high to the low, gold has moved up to about 50%, close to 60, and then settled back down. It's now at a 38% level. So that is a level that could be held easily, and I believe inevitably gold will return to rally mode and challenge at least 5,400, the opening price that occurred before the big sell-off. I look at the range in terms of where the market's been in terms of absolute highs. This high was an intraday high. It was a wick. What that means is when it went there, it didn't hold. It was unsustainable, and it actually fell from 56 back down to 54. So it took back $200. So the real range to me is about 5,400 to about 4,600. And what I'm disregarding is these wicks, these intraday highs and intraday lows, because they weren't sustainable. In other words, if it closes at that point, that means that as the traders brought it down to those lows, there weren't people buying the dip. They were thinking either it's going lower, they were uncertain, but it wasn't a point for them to bid it higher, which means that it wasn't oversold. Overbought is simply as it goes up, there's a point at which it's too high, traders are going to enter and pull profits or initiate shorts. So we're really not at mid-range. 50% would be right around 5,000, and right now we're trading just under that, 49.97. So according to the basic ABC tenet, it should go a little lower. I'm thinking if it does a flat, so call it 4,700, at that point it's completed that sell-off cycle, and it goes into the next, what's called an impulse or motive phase, which means you're looking for it to go into rally mode with 5 waves, 1 being up, 2 and 4 being counter waves moving down, but 1, 3, and 5 taking us to higher pricing. And if that's the case, by virtue of that theory, it will go above 5,450. So I'm exceedingly bullish once we have some sort of confirmation that this correction, because I do not believe we have pivoted from bull to bear market sentiment. Absolutely not. The key indicator to market technicians is this green line here. These are 2 moving averages, very short. What I could go short term, I used to use when I was younger, 13 minute, 7 minute. This is a 20-day simple moving average and a 50-day simple moving average. According to most market technicians, including myself, the easiest way to black and white technically determine is it a bull or bear market. If it's above the 50-day simple moving average, we're in a bull market. If it's below it, we're in a bear market. Now, to give you an idea, if I compress this chart and I'll move it back in a second, I'm going to have to rescale it. You can see this cross that came in. In other words, when you have a consolidation market, see how close these 2 lines are? And I'm looking at a period from August 25 back to about May 25. And you notice the green and purple line are right on top. Here's the breakout. And what you want to look at in a breakout is a widening of the moving averages. As they widen, it tells you it's gaining strength. As it narrows, it's telling you it's kind of losing strength. And then here where we went parabolic, depending on how you compress the chart, but this is as close to parabolic as you can get. And that's when it moved to the all-time record highs. You can see this base here. That's why I've got that rectangle there. And that's kind of how I look at it. Then if we zoom back in, you can see these moving averages are pretty much widening. And what's on the bottom is called a relative strength indicator. It's a momentum indicator that determines technically if it's overbought or oversold. When it moves over 70 in this kind of a technical study, it is considered overbought. And that's when we look for possibly to correct or come down. If it goes down to 30, which we have not seen, that means that it's in a sell-off, and that's really time when a market technician is going to look to accumulate. Right now, it's sitting at 55 and 51, and what that means is kind of right in the middle. So it's closer to overbought than oversold, but it's right in the middle. So it tells me that if it does continue lower, we'll see, as long as we see this correction, this will go lower. But at the point at where it finds support, it's going to move back kind of like it did here, which well over the 70 line. So what's my conclusion? My conclusion is we could see gold drift lower, but the way I look at it, it's rather than a hard fall, it's almost been sideways, which is a way of saying it's building a base, it's consolidating. And again, these technical indicators are a footprint. It's a map, but you can't follow the map. Sometimes it closes roads, sometimes construction happens. In other words, they're not written in stone. So we could see at any moment gold take off. And if it does, this is the market's going to challenge 5,400 basis, the April futures contract, which is probably about 53.80, 53.70 for spot. The closer it gets to breaking above this 20-day, that's going to be where, if it does close back above that and move off of it for 2 days, that's when us market technicians will label that as a breakout and a stronger potential for rally mode to enter. If it continues to go down, I would want to see how it reacts at the 50, because that's a critical mark. You get a lot of selling pressure if it actually goes through this area. Now, when we look at silver, you see that there are absolutely different parameters going on, but that overall is how I'm viewing the market currently.
Gold and silver prices are solidly lower in early U.S. trading Monday, with week-long liquidation from the shorter-term futures traders featured. There's an old trading adage that says a bull market needs to be fed fresh fundamental fodder often to continue its bull run. Despite volatility, it is consolidating within a strong range, holding key moving averages and building a base for a possible breakout. If this is truly the second phase of a monetary bull market, could the next wave higher catch the majority of investors unprepared? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.